corporate finance practice problem using Onenote. Acquisition and tax carryover with even cash inflows. Get ready, it's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 2010 Acquisition and Tax Carryover with Even Inflows tab. Also note, when using Onenote, look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking for an acquisition type of situation, where one company is considering the acquisition of another company. When you think about these acquisitions, obviously they can get quite complex, but they're going to have components of them that will be similar to the capital budgeting type of decisions, those types of decisions where you're thinking about long-term investment decisions that will happen into the future, and therefore you got to be considering time value of money, and you might be taking into consideration present value type calculations for those kind of decisions, including net present value and internal rate of return. So if you want to get better at kind of like those concepts, you can go to the capital budgeting situation where we focus in on them more. We'll be using some of those tools here as we apply them to a similar but different situation where we have the acquisitions and mergers types of situations. So first we have the cash purchase of a company. So they're thinking about purchasing just simply with cash for the $2,500,000. The company to be purchased has a loss carryover of the $650,000. Now, the loss carryforwards can be significant and interesting because they could provide a tax benefit to the acquiring company. What will typically happen oftentimes for the taxes is that if there's a loss, sometimes you can't take the loss, so you'd have to carry it forward. You got to match it up against other income. So if there's a loss that couldn't be taken, but possibly they could match it out against income, the acquiring company, if they have some income to match it up against, might get the tax benefit of that unused loss, which could be a nice incentive to be along with the purchasing process. So we've got the $650,000. We're going to assume the tax rate then at the 30%. The potential cash inflow from the investment we're going to assume is the $310,000 over 16 years. So in other words, if the new company is purchased, we think that it's going to generate inflows from that company. We're going to assume 16 years out into the future. Note, like the capital budgeting situations, these can be substantially long situations into the future that we're considering these cash flow options. And so we're going to say 16 years out. We're going to say that the inflow is even at the 310, which is kind of a simplified scenario, given the fact that we're not, because oftentimes we might assume that the cash flow would increase going forward, and we'll do some more scenarios that are a little bit more complex in the future. But if we got that nice even cash flow, we can use an annuity calculation, whereas if we had uneven cash inflows in the future, then we would have to do more present value calculations on a year-by-year type of basis. The discount rate we're going to use is to 12%. That might be called the cost of capital. The hurdle rate, the required rate of return, that 12%, in other words, like with the capital budgeting decisions, represents what we expect in the return within it. So when we do the net present value calculation, if we get zero, then it still might be something we accept because that means we cleared or at least met the hurdle rate of that 12%. So in other words, that rate does not represent the interest rate. It represents the minimum return we're looking for. Okay, so let's look at the cash outflows. On the cash outflows side of things, we got the payment of the $2,500,000. We're going to say that that happens on period 0, day 1. And so we don't need to do any present value kind of stuff with the outflow. The outflow is straightforward, as it is with many capital budget types of decisions. The tax loss carryover then is the $650,000 up top. We're going to assume that we can take advantage of that right away in the first year and match it up against income in the first year. So we take that $650,000 times the 30%. That would give us a tax benefit of the $195,000. So if we kind of tie that out to our payment price, it's costing us the $2,500,000, but we're going to get back this tax benefit from the loss carryover of the 195. That nets out then the 2,000,005 minus the 195,000 equals the 2,305,000. And then we have the outflows that we're going to be having, which is a nice even 310,000 for 16 years, which we can use an annuity calculation on then because we have even payments going into the future. We're not going to do the annuity calculation like multiple ways, like with formulas and tables. We're just going to look at basically the Excel formula for it. If you want to look at present value calculations in general with different formats, take a look at a prior section. Or if you want to look at the capital budgeting where we focus on it a little bit more detail there as well, you can take a look at that. We're just going to use the Excel formula here. Also, we do work this problem in Excel. So if you want to work these calculations and these calculations in Excel, you can look at that, the practice problem, where we focus a little bit more on the calculations. So we're going to get to the result of 2,161,936. So that once again is taking that 310,000 that we're assuming we're going to be receiving every year for 16 years from the company that is being acquired. We're discounting that annuity at the 12%. The formula would look something like this if we did it in Excel. The present value of the rate, which would be that 12%, comma, the number of periods would be the 16 years, comma, the payment would then be the amount that we're expecting to get each year, the 310,000, and that would be it. There would be no future value because this is not a present value of 1. We're using the payment calculation because it is an annuity. So this would be the inflow that we're expecting, the 2,161,936 versus the outflow, the 2,305,000. You can see that the outflow is greater than the inflow. It's negative, in other words, for the net present value. Negative means we have not cleared the hurdle rate of the 12%. Remember that even if this was like 0 or 1, that if it was 1, that does not mean that we're just earning $1. So we're going to do it just to earn the dollar over like the interest rate or something like that. No, because this 12% includes our rate of return in it. So anything that was 0 or above, if it was 0 exactly, that would mean that we have the 12% return and therefore might pick up the project, given that that 12% includes the amount of income that we want in it. That's kind of like, sometimes they call it the hurdle rate, the rate we need to clear. So if it's 0, that means we cleared the hurdle rate and we may accept the project. Obviously, the bigger the positive number, the better. But anything above 0 or 0 and above means we cleared the hurdle rate, which does include our rate of return we're looking for, which in this case was the 12%. However, this one, of course, is negative, meaning we didn't clear the hurdle rate. And so that means that we might not be picking it up if we wanted to clear the hurdle rate. We would deny the project or the purchase if that was the condition that we're making the decision upon.